Hey guys, and welcome back to the channel. My name is Landon, and in today's video, I'm going to be talking about the differences between mutual funds, index funds, and ETFs. These three terms are often used interchangeably, but are all slightly different from each other. Alright, so let's start with mutual funds. A mutual fund is an actively managed portfolio of investments that pools together investors' money into one fund in order to purchase stocks, bonds, and other types of securities. Mutual funds are actively managed, which means the fund manager or a team of fund managers make the decisions on what securities to buy, sell, or hold. These fund managers make the decision to buy, sell, or hold securities based on research, forecasting, and their own judgment and experience in making investment decisions. So one of the benefits of investing in a mutual fund is the diversification. Rather than picking individual stocks that may or may not perform well, a mutual fund is usually a safer bet because it represents a larger sector of the stock market. Another benefit of investing in a mutual fund is the convenience factor. Instead of doing lots of hours of research and forecasting on what kind of investments that you want to make, investing in a mutual fund can allow you to just dump your money into the fund, let somebody else who knows what they're doing take care of your money, and hope to see decent returns. But letting somebody else do the investing for you brings me to my first downside of investing in a mutual fund, and that is the high expense ratios. By letting somebody else do the investing for you and do all the work of research and deciding what securities to buy and sell, you're going to pay a price for that. And oftentimes these percentages for that work can be as high as 1%. So what that means is if you invested $1,000 into a mutual fund and the managing fee was 1%, you would pay $10 every single year to have your money in that mutual fund, regardless of how the mutual fund performed. Now, there are mutual funds that are less than 1%, but when you start making more money and when you start investing more and more money, that percentage becomes a huge deal into your capital gains and losses. Another downside of investing in a mutual fund is that they often have minimum investments, and these minimum investments are oftentimes $1,000. So if you're just starting out investing, this may not be the best option for you. All right, so moving on to the index fund. An index fund is a type of mutual fund, but it's got a few differences. And one of the first differences I want to talk about is that it's passively managed, which means that there's no team of managers or no fund manager that is actively looking over this fund and making decisions on when to buy and sell things. Index funds are funds that contain a wide variety of different companies and different sectors of the market. So for example, instead of going out and researching and investing in 500 different companies, you could invest in the S&P 500 index, which basically groups together a very small portion of the 500 top performing stocks in the United States into one fund, which makes it really easy to go out and purchase instead of doing all the hassle of going out and buying 500 of those individual stocks. So an index fund, as the name implies, is based on an index. An index is just a hypothetical portfolio that tracks a certain segment of the market. So for example, back to the S&P 500. The S&P 500 index measures the gains and losses of the top 500 performing companies in the United States. Another difference between mutual funds and index funds is the expense ratio. So unlike mutual funds where you might expect to pay up to 1% or more for investing in that fund, with index funds you have a much lower percentage, such as like 0.15% or sometimes even like 0.05 or even 0. And that's because of the passive management instead of the active management in the mutual fund. Index funds can only be bought and sold for the price set at the end of the trading day. This isn't really that big of a deal for long-term investors because a trade made in the middle of the day will likely not have an impact on a long-term, say 20-year investment. So moving on to the next type of investment, that is the ETF or exchange traded fund. An ETF is very similar to an index fund except for one major difference. And that difference is an ETF is traded just like a stock, meaning it can be bought and sold at any time throughout the trading day. Since ETFs can be traded just like stocks, they're perfect for beginner investors who don't want to have to pay somebody else to invest their money for them, but yet want that diversified portfolio. So apps like Robinhood or different platforms will allow you to trade these ETFs completely commission-free. This is a really great start for long-term investors who are just looking to get started and may not have all the knowledge quite yet into picking individual stocks. So for beginner investors, I definitely recommend looking into ETFs and index funds. So hopefully after watching this video, you're a little bit more clear on the differences between mutual funds, index funds, and ETFs. If you have any other questions or comments, post it down in the discussion below. If you like this type of content and would like to see more videos like this in the future, consider subscribing. Thanks guys, and I'll see you in the next video.